If you're brand new to investing and you have no idea where to start, this video is for you. Whether you're 18, in your 30s, 40s, or even in your 60s, today I'm going to show you exactly how to start investing in 2026 in a way that's simple, realistic, and actually achievable. We're going to look at how much you'd need to invest at different ages, where beginners should be investing their money, what to invest in, and the most common mistakes that stop people from ever getting started. And just to be clear, you don't need to be rich, you don't need perfect timing, and you don't need complicated strategies. You just need a plan and to start. So if you want investing to be as effortless as possible, let's get into it. Before we talk about what to invest in, we need to talk about why starting matters so much. One of the biggest advantages you can have as an investor isn't knowledge or even money, it's time. So let's look at what happens when you start investing at different ages. For this example, I'm going to keep things simple. I'm going to use a nice round number that everyone appears obsessed with. So the example is going to aim for a portfolio value of £1 million by the age of 65, assuming an average of 10% annual return with monthly contributions. These are just examples, not guarantees and not suggestions, but they help show the power of compounding. If you start investing at 18 years old, the monthly amount needed is relatively small. You're letting time do most of the work for you. The money you invest in your early years has decades to grow, compound, and compound again. Now, if you're at 30, the monthly amount increases, but it's still very achievable for most people. You've lost some time, but you still have a strong runway ahead of you. At 40, the number jumps again. This is where consistency starts to matter more than anything else. You're investing more each month, but compounding is still working in your favor. If you start at 50, the monthly contribution is much higher. There's less time for growth, so you're relying much more on how much you put in rather than how long it compounds. And finally, if you start at 60, the number becomes very large. At this point, reaching £1 million may not even be the goal, and that's okay. The point of this isn't to scare you or to make you feel behind. It's to show you that time beats timing, and that starting earlier makes everything easier. How much you contribute each month will largely be dictated by how long you plan to invest for and what your end goal is. So don't think too much about the £1 million example. The most important part is that you can't change when you should have started, but you can control when you start, and hopefully that time is now. The best time to start investing was years ago. The second best time is today. Now that we've looked at why starting early matters, let's talk about where beginners could actually invest their money. Because one of the biggest reasons people never start investing is that they don't know which account to use. In the UK, there are 3 accounts that are especially relevant for beginners. And the good news is you don't need all of them on day one. The first, and for most people, the best place to start, is a stocks and shares ISA. Any money you invest inside a stocks and shares ISA grows completely tax-free. That means no tax on growth, no tax on dividends, and no capital gains tax when you sell. You can invest up to £20,000 per year, and you can add money monthly, weekly, or whenever you like. For beginners, this is usually the simplest and most flexible option. If you're just starting out, this is the account I'd focus on first. The second account is a SIPP, which is a personal pension. The big advantage here is tax relief. For every £80 you invest, the government adds £20, giving you an instant 25% boost. The trade-off is that you can't access this money until later in life. You can usually start withdrawing from a SIPP at age 55, but this increases to 57 from April 2028, known as the normal minimum pension age. You can typically take 25% tax-free, with the rest taxed as income, or use flexible options like drawdown, annuities, or lump sums. So a SIPP is best for long-term investing when you're happy to lock the money away and let it grow. For many people, using a combination of a stocks and shares ISA and a SIPP can be very powerful. But if you're a complete beginner, it's absolutely fine to start with just one. And finally, a quick mention for any of you watching who have young children, the Junior ISA. This allows you to invest for your children completely tax-free until they turn 18. There is a £9,000 limit, but anyone can contribute to it, whether they be friends or family. Thanks to compounding, even small monthly amounts can grow into something meaningful over time. The key thing to remember is this: you don't need to overcomplicate things. One account, one plan, consistent contributions. That's more than enough to get you started. So now we know why investing matters and where beginners should be investing. The next question, and probably the most overwhelming one, is what should you actually invest in? There are lots of options out there, and if you're new to investing, it can feel like you need to understand everything before you start. The truth is, you don't. Nevertheless, I'm going to go quickly through each asset class as simply as possible. Let's start with cash. Cash is safe. It doesn't go up and down, and it's useful for emergencies. But over the long term, cash usually loses value to inflation. So while it's important to have some cash set aside, an emergency fund is a great example of what to store your cash for. It's not where your money grows. Next are individual stocks. Stocks can offer strong growth, but they also come with higher volatility, especially if you only own a few companies. For beginners, picking individual stocks can add unnecessary stress and volatility. It can also be quite time-consuming to understand all that you need to know about a company before you invest in them. This is where index funds and ETFs come in. Instead of buying shares in one company, you're buying hundreds or even thousands of companies in one go. That instantly gives you diversification, lower volatility, and much less effort. For most beginners, this is the foundation of a solid portfolio. You might also hear about REITs, which give you exposure to property without buying a house. They can provide income, sometimes monthly, but they're usually more relevant once you already have a core portfolio in place. Then there's commodities such as gold. Gold is often seen as a hedge against uncertainty, but it doesn't produce income and doesn't grow in the same way businesses do. Nevertheless, if you look at the price of gold over time, it's only gone up. For beginners, it's optional, but not essential. And then there's crypto. Crypto is high risk, highly volatile, and not necessary to be a successful investor. If you do invest in it, it should be small, optional part of your portfolio, not the foundation. So what would I personally recommend for a beginner? If you want the most effortless approach, an all-world ETF is hard to argue against. With one investment, you get exposure to thousands of companies across the globe. It's low cost, highly diversified, and designed for long-term growth. You don't need to constantly monitor it, and you don't need to make complicated decisions. All you need to do is keep averaging your position with your monthly contributions. For most people starting out, this is more than enough. Even if you choose the right account and the right investments, there are a few common mistakes that stop beginners from getting the results they're hoping for. The good news is they're all avoidable. The first mistake is owning too many overlapping funds. A lot of beginners think that more funds mean more diversification, but that's not always true. If you own multiple funds that all track similar markets, you're often just buying the same companies again and again. It adds complexity without adding real benefit. You're duplicating, not diversifying. For most beginners, one or two well-diversified funds is more than enough. The second mistake is ignoring fees. Fees might look small, 0.5% here, 1% there, but over decades they can cost you tens or even hundreds of thousands of pounds. Low-cost investing doesn't mean low quality. In fact, keeping fees low is one of the easiest ways to improve your long-term returns. The third mistake is investing without a clear goal. If you don't know why you're investing, it's much harder to stay consistent when markets fall. Your goal doesn't have to be complicated. It might be financial independence, a comfortable retirement, or simply building a bit more security for the future. But having a plan gives your investing purpose, and purpose makes it easier to stay the course. Most investing mistakes aren't about choosing the wrong fund. They're about overcomplicating things, paying unnecessary fees, and reacting emotionally. So now that we've covered the mistakes to avoid, let's finish with how to make investing as simple and effortless as possible going forward. At this point, you don't need more information, you need a simple system. Because the best investing strategy is the one that you can actually stick to. For most beginners, keeping things effortless comes down to a few key habits. First, automate your investing. Set up a monthly direct debit into your investment account and treat it like a bill. This removes emotion, removes decision making, and keeps you consistent. Second, focus on time in the market, not timing the market. You don't need to predict crashes or wait for the perfect moment. Long-term investing rewards patience, not perfection. Third, increase contributions when you can. As your income grows or expenses fall, even small increases can make a big difference over time. And finally, ignore the noise. Headlines, hype, and short-term market movements don't matter nearly as much as consistency. Your portfolio will go down at some point. That's normal. What matters is staying invested and giving compounding the time it needs to work. If you take one thing away from this video, let it be this. Starting matters more than starting perfectly. If you found this video helpful, give the video a like, it really helps the channel. And if you want realistic, low-effort investing content, consider subscribing to the channel as well. And let me know in the comments, when did you start investing? Or when are you planning to start? That's it for this video, and as always, keep it simple, keep it realistic, and keep it effortless.